All right, let's dive right in. If you've been keeping even half an eye on the financial news lately, you've probably seen some pretty alarming headlines. In just the last few weeks, international markets have been absolutely rocked. It sparked widespread panic, and get this, searches for the term market bubble just hit their highest level since 2004. We are literally watching a historic event unfold right before our eyes. So today, we're going to break it all down, strictly by the data. In this explainer, we're unpacking exactly what just happened overseas, why it actually matters, and most importantly, what this means for us as everyday investors when that opening bell rings on Monday morning.
To really grasp the sheer scale of what we're dealing with here, think about this number for a second. 1.2 million. That is the number of retail investor accounts in South Korea that were just hit with margin calls. Seriously, let that sink in. That represents roughly 1 in every 30 people in the entire country facing a sudden, forced demand for cash from their brokers, all in a remarkably short window of time.
So, how did things go wrong so fast? Let's get into Section 1, the South Korean AI collapse, which saw a brutal 25% drop in just 21 days.
See, just a few weeks ago, South Korea's stock market, the KOSPI, was actually the best performing in the world. But it had a fatal flaw, a severe lack of diversification. Roughly 14 million retail investors over there, who affectionately call themselves ants, took some extreme risks. A staggering 56% of their entire market index was concentrated in just 2 single companies, Samsung and SK Hynix. Essentially, an entire nation's diversified index fund mutated into a giant, highly leveraged bet on AI memory chips.
And man, when that bet went sour, it soured violently. In late June, U.S. chip stocks started selling off ahead of earnings, right? Well, that nervousness immediately crossed the Pacific. Because the Korean market was so dangerously concentrated, that initial dip triggered a massive, automated forced selling event. Over 3 trillion won in investments were just liquidated. Poof! Regular investors were completely wiped out, which actually prompted the president of South Korea to step in and hold an emergency intervention for their stock market.
Let's strip away the financial jargon for a minute and look at Section 2, Anatomy of a Margin Crash, to see how this doom loop actually works.
The ultimate culprit here is leverage, specifically buying stocks with borrowed money. When you do that, and the stock drops to a certain price, you get hit with a margin call. Your broker essentially knocks on your door and demands you deposit more cash, immediately. If you don't have it, they force sell your stock at whatever the current market price is, just to cover their loan. In South Korea, retail investors were heavily relying on 2x and 3x leveraged single-stock ETFs. So when those chip stocks dipped, they were forced to sell their holdings, locking in massive, life-altering losses.
And this triggers what traders call the doom loop. It's pretty simple, really. First, stocks drop, hitting a threshold that triggers margin calls. When investors inevitably can't pay up, brokers force sell their shares. All that forced selling floods the open market, which pushes prices down even further, which, you guessed it, automatically triggers the next wave of margin calls. It is a vicious, completely automatic cycle where the drops literally fuel more drops. Human decision-making is entirely removed from the equation.
Which brings us to the most pressing question for us today. Section 3. Are U.S. markets next? Let's look at the warning signs right here at home. Was South Korea an isolated, freak event, or was it a preview of coming attractions? The crucial thing to understand is that the U.S. currently shares some pretty eerie similarities with Korea's 5 ingredients for a crash. We've got extreme concentration in just a handful of stocks. We've got a massive rally entirely driven by AI hype. We have record amounts of retail leverage, heavy insider selling, and frankly, extreme valuations. Right now, the Shiller-Cape ratio, which is a long-term market valuation metric, is sitting around 41. To put that in perspective, at the absolute peak of the dot-com bubble, it was 44. So by almost every historical standard, the U.S. stock market is incredibly expensive right now. But let's look at the actual data. Yes, the top 10 stocks in the S&P 500, your heavy hitters like Nvidia and Apple, make up about 37% of the index. The remaining 63% is still vastly more diversified than the KOSPI. Is 37% historically high? Oh, absolutely. But it is a very, very different structural setup than having 56% of your entire market crammed into just 2 specific memory chip companies.
However, there is a major red flag we cannot ignore: $1.5 trillion. According to recent FINRA reports, U.S. margin debt hit that staggering level in June of 2026. That represents about 4.5% of the entire U.S. GDP. It is the single highest level of borrowed money in the stock market ever recorded. And keep in mind, this doesn't even count the hidden leverage baked into options or those 2x and 3x leveraged single-stock ETFs here in the States.
And if we look at the timeline of history, it tells a very sobering story. Every single time U.S. margin debt has reached an extreme peak relative to the broader economy, a massive market correction followed almost immediately. August 1987 preceded Black Monday. March 2000 was the exact peak of the dot-com bubble. July 2007, right before the global financial crisis. August 2021 preceded a major correction, and here we are, staring at June 2026, sitting at all-time record highs.
But before you run out and liquidate your entire portfolio, we have to look at the other side of the coin. Section 4, the case for optimism and our U.S. safety nets.
Because despite these genuinely scary parallels, institutional money managers on Wall Street are positioning themselves very, very differently than retail traders right now. We have to ask ourselves, is the U.S. actually structurally different from South Korea? Does our market have safety nets that theirs simply lacked? And honestly, the data suggests that yes, it absolutely does.
The U.S. has some massive, distinct advantages. We have the deepest, most diverse institutional buyer pool in the world. We're talking pension funds, university endowments, foreign governments. We have trillions of dollars in 401ks generating automatic, relentless buy orders every 2 weeks, completely regardless of market conditions. We have decades of tested circuit breakers specifically designed to halt trading and stop a doom loop dead in its tracks. And perhaps most importantly, this current rally isn't just empty hype. We are seeing blended earnings growth running near 25% with revenue growth near 13%. Real, tangible money is being made by these companies.
This fundamental strength is exactly why Goldman Sachs just raised their year-end target for the S&P 500 to 8,000. These major banks don't see an impending collapse. They actually see a rally that is broadening out. The Russell 2000, which tracks smaller companies, is up over 16%. We aren't just relying on 7 tech giants to carry the market on their backs anymore. Smaller companies are participating, which is the exact sign of a healthy, robust market environment.
So what's the catch, right? Let's move into Section 5, the AI spending catalyst, the ultimate market linchpin.
Because beneath the surface of all these numbers, there is one major linchpin holding up this entire global market right now. And that linchpin is hyperscaler capital expenditures. Microsoft, Google, Amazon, and Meta are on track to spend a combined $725 billion on AI infrastructure in 2026. Remember, one company's massive spending is another company's earnings. This insane outlay of cash is what's artificially boosting the earnings of chip suppliers like Nvidia, which in turn is what justifies the entire stock market's current sky-high valuation.
But here is where the math gets a little dicey. Currently, these top tech giants are expected to spend $1.57 for every single dollar they make back in operating cash flow from AI. That return on investment is shrinking, and it's shrinking fast. A year and a half ago, they were earning 40 cents of operating income on every incremental dollar invested. Now, it's down to about 20 cents, and it is heading straight toward 10.
This brings us to the ultimate tipping point. Scenario A. Hyperscalers sustain this massive spending, AI actually delivers on its massive productivity promises, and these companies simply grow into their valuations, kind of like Amazon did after the dot-com crash. But scenario B, that is the danger zone. If just one of these tech giants decides the ROI just isn't there anymore and cuts their AI budget to save money, it could utterly collapse the earnings of the chip suppliers. Think about the year 2000, when Coca-Cola suddenly cut their router orders from Cisco, and Cisco stock dragged the entire NASDAQ down 78%. A cut in AI spending today could trigger the exact same margin called doom loop in the US that we literally just witnessed in Korea.
So where exactly does that leave you and me? Let's wrap this up with Section 6, your pragmatic investor playbook, and go over some grounded steps we can take.
We've looked at all the heavy global macroeconomics, but now let's get into the actionable advice. Surviving market volatility really comes down to one golden rule. Never, ever put yourself in a position where you are forced to sell. Step 1. Build a solid 3 to 6 month cash emergency fund, so if you lose your job, you don't have to touch your investments. Step 2. Diversify your assets. Spread it across U.S. markets, international markets, real estate, maybe commodities. Whatever you do, don't put 56% of your net worth into 2 chip stocks. And step 3. Avoid leverage and margin debt at all costs. Look, the market is dangerous enough on its own without borrowing money to gamble with.
I really want to leave you with this incredibly powerful historical fact. A 20-year holding period in the S&P 500 has historically never produced a negative result. The market doesn't have to be a massive bubble to be dangerous, and it also doesn't have to completely crash for you to get a good deal. History shows us time and time again that the market heavily rewards extreme patience over short-term panic.
Which leaves us with this final crucial question to ask ourselves. Will you let short-term panic disrupt your long-term patience? We've seen the hard data, we've seen the devastating risks of leverage, and we've also seen the unique structural safety nets of the U.S. market. The key here is to stay informed, prepare your portfolio, and rigidly stick to your strategy. I hope this explainer gave you some valuable, grounded insights to help protect your financial future. Stay patient, stay diversified, and I'll catch you in the next one.